So it is straight up 8 o'clock, and we're going to begin this webinar. We're going to do crop insurance, ARC, and risk management update. I'm Gary Schnitkey, and Nick Paulson is here. And
good morning.
And Bruce Sherrick helped put some of the material together that we're using here today. So here is, I'll get this over here. Here is our outline for today. We're going to first off just talk a little bit about risk management and where we're at in 2016 as far as budgets. Then we're going to talk about crop insurance. Essentially, we're going to say something to the effect, if you're a corn and soybean farmer in the Midwest, you'll likely want to take 80 to 85% coverage level. If you're in the heart of the Corn Belt, maybe going down to 75%. Probably looking at RP or RP with exclusion. Some individuals are looking at whole farm policies. They are fine. The one thing that I would mention about those is they probably, whole farm are harder to trigger than an individual crop, and as a result, individual crops will probably provide a little bit more coverage than whole farm. They're a bit easier to understand as well. We'll also talk about YA, YE, and TA is the trend adjustment. All those we would suggest taking if they raise the APH yield, or the trend adjusted APH yield, or the approved yield. We'll then give a discussion of ARC and where we see payments in 2016, and unless you're in Piatt County, you're likely to get a payment in 2016 if you're in Illinois. And then we'll summarize. One other thing that we're going to point out as we're going through that is that we do have some new tools available in the crop insurance section of FarmDoc. We will show those tools and may actually demonstrate those as we're going through this. So that's our outline, starting here with risk management and budgets. Just a note. Typically, when you're looking at risk management with tools, we start out with balance sheet reserves, working capital, and then credit reserves. Just to note that most farms have pretty good working capital, but are drawing it down, probably have drawn it down in 2015 by a pretty good amount, and likely drawing it down again 2016. The other thing is then we'll be revolving around credit reserves. Second line of defense, and that often is used as crop insurance and marketing, and then those are followed by ARC and government payments. Generally speaking, ARC, if you're looking at it, probably protects against longer-term phenomena like price declines, like we're having right now in both corn, soybeans, and wheat, and crop insurance provides within your coverage. Here, I'm just going to put a budget up here for 2016. This happens to be for corn, 200 bushels, and I just want to make a couple points here. We have total cost here. This happens to be for cash rent land, $270 per acre. You can see the direct cost listed there, power cost, other cost, $822 per acre of total cost given cash rent, $270 per acre. We're expecting an ARC payment for 2016 crop, which will actually be received in 2017. Pretty soon, towards the end of this seminar, or we'll be talking. We'll be much more specific about what the 2015 payments look like. Overall, a lot of Nick, to correct me if I'm wrong, they're going to probably be near maximum in a lot of counties for corn.
Yeah, a good portion of counties across the country, really, and especially right in the heart of the Corn Belt, will have ARC payments, and a good portion of those will have the maximum ARC payment available, which is 10% of whatever the county revenue guarantee is. So the 2015 ARC payments, which again will be received sometime around October of this year, are going to be larger than that $40 number Gary has in the 2016 budget. That's representing the 2016 crop year ARC payment estimate, kind of a rough estimate right now, which, like Gary said, won't be received until harvest of 2017.
So we're just putting this in a budget. And again, given if we have prices below $3 or $4 on corn, we would likely have a payment, but that's still we aren't near the point of determining those. That gives us total cost minus that Ark County payment of $782. If we're looking at 200 bushel yield and lower the yield, lower the cash rent, you'll probably have roughly the same sort of situation here. $391 break even price. That's just our cash price are below that. From a crop insurance standpoint, right now we're looking at a situation where you're not going to be ensuring a profit, but minimizing losses. Another scenario here, just to put some more bones on this scenario. Let's say you don't want to cover depreciation. You're not going to buy any equipment here, so you don't feel like you need to cover depreciation cost. So I took the depreciation cost, the machinery cost out, the building cost. Your break-even price is still $359, and there's still that's about what cash bids are right now for fall. So we could, even if we don't want to cover depreciation costs, still in a position where our cash costs won't be covered this year. Finally, all right, you don't want to cover depreciation, and you don't want to cover overhead. All right, so you're going to eat the overhead this year somehow. $331. There is a possibility that prices could be below that. Probably less so, but still potential. Here's the point, though, that we are in a situation where we're pretty risky, and we're going to use crop insurance to protect against those risks. Again, we're going to suggest here having pretty high coverage levels because there is considerable downside risk here. Same thing for soybeans. Just did the same thing. This is 56 bushels per acre. Actually, 60 bushels. I made a mistake here on this slide. 970 is the breakdown for total cost. Well, our current cash prices are in the high eights. 863 with no depreciation, and then 787 for no depreciation and overhead. Again, just the point that we aren't using crop insurance in most situations to ensure profits, but to hold down those losses. Again, we will likely on many farms be reducing working capital in 2016. And crop insurance in this case is to minimize the losses that we can see on that working capital, given prices that are low or yields that are low, or some combination that gives us low revenue. So that's the budget outlook. And again, just coming back here, we're sort of looking at break evens here of threes in the corn, 360 to 390 for corn. 80 for soybeans. Here, if we were setting the projected price today on crop insurance for Midwest crops, so this is for Illinois, corn and soybeans in Illinois and most of the Midwest states. Those projected prices are based on the February contract settlement prices. They're the average of the February price, so we're not done quite yet with February. That 387 to 887 were as of last week, so we could see some variations from those prices from there. But if we had set it for the first couple of weeks in February, we would be a 387 projected price for corn, 887 for soybeans. Couple of notes here. First is that 387 is lower than any that we have up here. 2011, 601, 568 for 2012, 565, 462, and 415. We're on a steady downhill slide since the 2011-2012 period. That 387 would take us back to 2009 as the period that was set, or 387. It was 390 in 2009. Again, this is going to set our guarantees, and again, we're looking at lower guarantees than we have been in the previous years, because that projected price times the APH yield, or approved yield used in your yield calculation times your coverage level. So again, those projected prices are coming down. We won't know those harvest prices obviously until later this year. For Midwest crops, they are set by the average of the settlement prices. December contract for corn, November contract for soybeans, those settlement prices in October. So we're looking again at lower projected prices now. It'd be really hard to see that our projected prices change substantially from those levels at this point in time. Again, we're looking at something like, if I took our examples here, 387 is our projected price. Right now, our last week, there was about a 25-cent basis on fall delivery, kind of contracted something in the 360 range. 200 bushels, we're looking at $724 of expected revenue. Our RP guarantee would be $657 per acre, taking 85% of that. And again, we're looking at something in the range of $737 of total cost expected. Again, so we're below those levels. Same sort of situation for soybeans. 887 is the projected price as of the first 2 weeks. Could have been locking in or forward contracting at 20 cents below that. 520 would be the expected revenue. Guarantee, given a 60 bushel expected yield, would be 452. Again, total cost 582. So we're below that. Again, I mean, one of the things that in this cost-cutting environment you may be thinking about cutting is that coverage level to save on cost. We would caution against that, I guess, because you're going to expose yourself to more downside risk, and again, there is that potential for having much lower revenues as we're moving through the year, either because of lower prices, lower yields, or some combination there.
Well, I think it's probably really important, Gary, too, to point out that you need to be aware of not only what your coverage level is, but what that revenue guarantee is in terms of dollars per acre, because it's undoubtedly going to be much lower than it's been last year, and definitely compared to the 2 or 3 crop years before that. So you're covering even if you're buying the same high coverage level, you're covering a much smaller amount of revenue per acre with the lower prices. So,
yep, and so that is where we're at. And again, these crop insurance products reset their guarantee each year, depending on where the market is, based on where that projected price is. So here's where we're at. Now we're going to move into crop insurance choice. And just a further note here's what we've seen people do over time. I'm showing these for corn statistics or corn policies in Illinois. You would see roughly the same sort of thing going on for soybeans as well. We had revenue products, and these are for revenue products, Illinois. And I'm just going to focus on the green line here, which is revenue products, which would be now RP and RP, HPE. There were predecessor products to this. And at the 80 and 85% levels, 0% sold in 1998 because those coverage levels didn't exist then. And as you can see here, that had just steadily grown to 2014 to something over 70% of the insured acres were insured using those sorts of revenue products. This graph goes through 2015. It was essential, or 2014, excuse me. They were essentially flat into 2015, and as we looked at it, the percent acres insured were flat as well, roughly at 85% of the acres insured. Here's a more detailed look of what we saw for insured acres in 2015. And this slide shows RP with harvest price exclusion, YP, ARP. ARP is the county level product. So this would be county level revenue protection, county level harvest price exclusion, revenue protection, and then the yield insurance. YP is a yield insurance, RP is a revenue insurance without the guarantee increase, and RP is with the guarantee increase. If you're looking at these, here's where we see people being insured. 76% of the acres are insured with RP, and they're primarily done at the 75, 80, and 85% coverage levels. And if you're looking at Illinois, 80 and 85 predominate in the northern and central part of the state. We see more 75% coverage levels in the southern part of the state and on high-risk land, particularly, or higher-risk land, and that just occurs because those 80 and 85% coverage levels get more costly. So if you were at RP at a pretty high coverage level, last year that you were in the majority. The other sort of larger part of the policies fell in ARP. So we saw most people taking RP or farm level option or county level option. And again, if you were there last year and were comfortable with those coverage levels and what you got from those products, that is probably a pretty good place to be this year. I would also point out RP with harvest price exclusion here, and we'll go through an example of this. And if you are concerned, you're concerned with the cost of the revenue guarantee, you might consider RP with the harvest price exclusion. It has a lower cost. It does have a big caveat on it, and that is that it doesn't have that guarantee increase, and that will pay much less during something like a drought year like 2012. But if you really want to get away from these, the premiums associated with these, you could move down to RP with harvest price exclusion. And in fact, I would go down here to this policy before I would think about a whole farm policy. So, just to summarize, sort of where we think most people should be at, and again, most people were right here. RP 75% or higher coverage level. We would suggest taking the trend adjustment, the trend-adjusted APH, and the yield exclusion, if the yield exclusion is available. We'll give an example here in a minute, but if those two things are available, they will generally increase the guarantee, and that guarantee will provide more coverage. You can, generally speaking, if you use trend adjustment on corn, you can often get 10 bushel increases in the approved yield. If you don't want the higher coverage offered by that higher 10 bushel yield, drop the coverage level, and it will generally cost less. That same dollar amount will cost less with trend adjustment than without trend adjustment. RP with exclusion, sort of the same criteria as above. Again, think about this for if you want to lower the cost, and also you don't want to do much pre-harvest hedging. This policy would be a good one also for share rent landowners. If you're a share rent landowner and do not do much pre-harvest hedging and want to provide a floor under the revenue, RP with exclusion is a low premium cost product. ARP is the county level product. Over time, this will pay out more than it will pay in, more than the other products. The downside is that it has a higher premium than the two products mentioned before. It's also based on county yields rather than farm yields, and it doesn't have any pre-plant or preventive planting provisions. One of the things you can do now, if you want, we've introduced 2 new crop insurance decision tools, web-based tools. The iFarm Premium Calculator is a tool that you can use to get premiums, and I'm just going to do a demonstration of that. I want to I'm going to try and do what I have in the slides on the web. This may or may not work. Here we are on our crop insurance site. You go into Farm Doc, go into the crop insurance section, and you will see the premium calculator, payment evaluator, and then we also have our fast tool here. But if we go into the premium calculator, you can select your state, your county, and I want to go to all my examples today are in Logan County. So if I get to Logan County, right there, I'm going to do this for corn, and I'm doing my example here for 190 APH. I'm going to take the trend adjustment 200, 190 for my rate yield. And then this product gives us premiums for all these products. Here you have revenue protection. Here you have revenue protection with the harvest price exclusion. Here you have yield protection. We currently have this in there at a $387 price, or $385 price. I'm going to put a $387 just to keep it the same. And as of last week, the volatility was 18, which is considerably below where we were at last year. Last year we were at 0.21. Here is those premiums for an enterprise unit, 85% coverage level RP product. So enterprise unit RP product, and by the way, this is 100 acres of in this unit, would be $16.56. So, and then you can go down here to $850.35 for 80%, $427 for a 75%. Again, we would suggest being up here at the higher coverage levels. We would also suggest being over here in the enterprise unit area. Enterprise units are all one crop in a county. So those enterprise units all on one crop in a county. Basic divides those crops up by ownership unit. So all owned land would be in one unit. All owned and cash rental land would be one unit. All share rent land would share rent by each share rent landlord would be another unit. An optional unit divides those basic units by township section. So
we do have a few questions, Gary, that came in on crop insurance.
We increased the font size for you.
Oh, there we go. So there was a question about trend adjustment. Is it worth the extra cost? I think you would say yes to that.
So all right. So here, this shows 200 bushel yield. So let me just give you an example here. So if I let me do this without trend adjustment. I would pay $13 for a guarantee of $6.25, and that guarantee is now based on 190 bushel yield. So if I wanted to buy a $6.25 minimum revenue guarantee, I would pay $13 for it. Use the trend adjustment. That guarantee goes up to $6.58. Costs go up to $16.56. But maybe I wanted to be a little bit, if I dropped my coverage level, I would sort of be between those two. $8.35 would be my cost. The way it works out, using trend adjustment, you will never pay more for the minimum revenue guarantee, but you can pay less because of the way the subsidies work in this process. All right. Other point here, and we'll come back to this. So now I could pay $16.56 for an enterprise unit. RP with the harvest price exclusion, I can drop that in half to $8.17. Again, if you're concerned about the cost of these alternative products, and obviously one of the things that we always talk about is reducing Non-line cost, one of the things you could do is move back to RP with the harvest price exclusion, cut that cost in half, but now the thing that you have given up is that guarantee increase, which could come in play if we have a drought year. Prices go up, yields go down, your coverage will be less than if you had not had that on there.
And we also had a question on just factors that affect the price of insurance, I guess the premium dollars that farmers will be paying. And the question, I guess, just wants a confirmation that premium costs in terms of dollars per acre will be lower this year. One, because of the lower price guarantees we have, so that's accurate. Although that also reduces the amount of coverage you're buying, so it's cheaper in terms of premium cost. That doesn't necessarily affect the rate or the relative cost of the insurance, but it does reduce the cost because it's reducing the amount of revenue coverage you have. And then the other factor is that we also have a lower volatility than we've had in years past, and that does reduce the cost of insurance both in dollars per acre and in relative or rate terms, right, Gary?
Yep. So this would have been, let me just give you, last year this would have been 21. So watch this, 656. Now I'm going to go up to 21. And you see that premium went up to $19.20. So this lower volatility, and again, this is likely to be in the 0.18, 0.19 range this year. So that as that goes down, that will lower our premiums. The volatility also, that going down is based on what's happening to options prices, and that also means that the market estimate of the volatility is coming down. So the market is saying that we have less variable prices this year than we did last year. Overall, though, we should see lower premiums. There are actually three factors. The projected price is coming down, so that would cause it to come down. Volatility is likely to be lower, so that's coming down. RMA also just changes the rates from one year to the next year, and those rates actually increased our premium. So if we were running this 2015, this might be $16.10 if we were running this with 2015 rates.
And these are all in dollars per acre. We had a question come in on that. These are
dollars per acre.
Premiums being quoted here are dollars per acre.
Yep.
And then we had a question about the rate yield there. Gary, I don't know if you have a quick explanation of what that rate yield versus the trend-adjusted yield versus APH.
All right. The rate yield in Illinois, the rate yield and the APH yield are almost always the same. The rate yield, most cases, is the average of your history of yields. The APH yield can differ from that if you've made any substitutions, YA substitutions. Then your APH yield could be higher than your rate yield, and your trend-adjusted yield would be after we add a trend adjustment to the yields. So those are the three yields. All right. I'm going back to my PowerPoints here. That didn't work that worked? Okay.
There we go. Yep.
Here I'm now you're seeing the same thing. I had these in a PowerPoint as well, just to be safe. All right. Again, I'm just going to run through a quick example here. Trend adjustment, 200 bushels for corn, 387 projected price. If our harvest price is below that, we will have a guarantee of 850. So as long as we have a guarantee, I'm sorry. Oops, this is I screwed this up. Let me do this example. I screwed that slide up. 200 bushel APH yield, 387 projected price. If the harvest price is above 387, the RP will use that higher harvest price in calculating its guarantees. Again, that harvest price will not be known until October. And again, this harvest price here, if the harvest price is below the projected price, we would be using that projected price in this guarantee increases. Just to give you a feel here, I'm just going to give you the payments for RP for different yields and different harvest prices. Here you can see for a $3 harvest price, you would get a $3.59 payment, $2.99 for 120 bushel yield, and you can see those decreases as the yields increase. So RP, we have the guarantee, which is the higher of the projected or harvest price, times the trend-adjusted APH yield or the approved yield, and also times the coverage level. You can see here as we have higher harvest prices, those payments go down because our harvest revenue is less. Except when we get up here to these higher projected prices and then the payments go up because our guarantee is going up. We're running an example here with a $3.87 projected price, $4 and $4.50. Our guarantee goes up and then our payments go up. This is what happened in 2012. So most farmers had our harvest price was above our projected price. We had lower yields and we had higher payments because of those higher projected or higher harvest prices. I'm going to show you. So this is RP per acre. Here is what those items in the red are RP HPE payments. As you can see there, they go down. And that is simply because RP does not have that guarantee increase in it. Again, those can go down substantially. So RP HPE premiums or payments there are in red. They will be lower than RP. If you're in a drought year, they will pay less than RP. The other caveat to using RP with the harvest price exclusion is that you should be doing minimal amounts of pre-harvest hedging, because actually if you're hedging with RP, you can be taking off the protection offered by the underlying insurance product. The guarantee increase in RP provides protections if prices rise. There could be payments in those cases. So the caveat here, and again, showing RP with HPE, they will differ from RP when we have harvest prices above the projected price. I want to also show now. So we're suggesting that people take RP with HPE, or also looking at ARP. A lot of the reasons for that you can look at in this iFarm payment evaluator, and this is a tool that we have on the web, and I'm in the crop insurance section, and I'm just going to run an example again through it. We had good luck with our previous one. So let me go here, and I'm going to go to the payment evaluator, and I'm going to go into Logan County. And what this program does is calculates estimated payments, average payments, frequency payments, net cost of insurance, and value at risk information for a case farm in each county for corn and soybeans. And this evaluator is available across most Midwest and Great Plains states. I'm going to look at the net cost of insurance here. And what this is net cost of insurance. This number is farmer paid premium minus what the average expected payment from crop insurance. You will note that those are negative, and that happens because all these products are subsidized. So what RMA does is calculates the expected payment from those products, applies a risk subsidy to them, and the farmer pays less than the expected payment from those products is. That's why these numbers are negative. All right, so when we look at this, you'll notice here that the most negative is ARP. and they average $42 per acre compared to $14.35 for RP at an 85% coverage level. And RP with the harvest price exclusion is -$7. So this product, and this happens to be a function of it having a higher expected payment when it does happen. It also has higher premiums, but overall, the payments from this product are expected to be higher than RP. Because of these expected payments being negative is another reason why we suggest taking high coverage levels, because over time these products will tend to pay more out than they pay in. May not happen this year, but on average, if we could repeat this many years, we would expect that to happen. This is a look at averages. We also calculate value at risk information. Now, I want to focus here. We do this at 1%, 5%, but let me tell you what this is. Without insurance, gross revenue, crop revenue, plus insurance payments minus the insurance premium averages with a 5% value at risk with no insurance is $415 per acre. What that means is that 5% of the time we estimate that revenue will be below this number without insurance. So you want that number to be as high as possible. Coming up here, we want those numbers to be high as possible. So with RP HPE, that number goes from 415 to 524. So now the 5% risk goes from 415 up over $100 to 524. RP has roughly the same sort of reduction, 524 to 513. So these two, RP-HPE actually has a bit higher than RP. Again, you have to take into consideration that if we have a drought year, you're not going to get as large of a payment, and you can take off the coverage from that if we have a loss situation. Here, ARP doesn't increase those as much as RP, and again, that's simply because you're insuring county yields rather than farm yields, and you can always have farm yields that aren't that don't match the county yields. The farm could have a loss, and the county could not have a loss, and for that matter, vice versa as well. So those are our tools. They drive a lot of our decision, our suggestions as far as where we are crop insurance wise. Here, these two slides in there show exactly the same thing as we did before. And again, a lot of this decision, RP, here's what I think it comes down to. RP at a high coverage level, RP HPE at a high coverage level. Again, if I were looking at lowering premium cost, I would think about RP HPE here before probably even the whole farm policy, and ARP. Again, ARP will tend to pay out more than the other products over time on average. It has higher risk than the other products as well. Again, just to give you a feel, and you can get these numbers on our premium calculator, this would be the premium cost of Logan County ARP, $47 versus this is the premium cost of $19. Again, we would suggest taking this at 90% coverage level, no prevent planting or replant provisions in ARP. Two situations where this fits in really well is new farmland in a county. So if you have new farmland, you probably would be using a T yield, which would be well below where you're at. And also if you're concerned more about price risk than real yield risk, and that's simply because you have a 90% coverage level, which would get you to prices below 348 versus an 85% coverage level. All right. YA, YE, TA, and we have, if you want to see what these products do to insurance guarantees, we still have our crop insurance decision tool. That's a spreadsheet that's downloadable from our website. Again, if you come in back here to our website, let me go to the top here. We're going to go to the farm. We have our premium calculator, our payment evaluator. You can also download our FAST tool, which is a Microsoft Excel spreadsheet, and you'll actually get the premiums there as well. And in that spreadsheet, we also can look at what YA, YE, and TA does to yields or approved yields used in making calculations. You actually have 3 adjustments that you can make to historical yields. And this will depend. You can do a YA. You can substitute 60% of a T yield in if the actual yield is below it. YE, if allowed, the yield can be excluded from APH yield calculations, and the RMA makes determinations of what counties can be excluded, and it's based on that county having a yield 50% below its 10-year average or the adjacent county, and then trend adjustment, which adjusts yields up. Here's the counties in Illinois where yield exclusion are available for 2012. You can see there's quite a few counties for which yield exclusion is available. Those 2012 is the year in which most in Illinois in which most yield exclusion was available. And if you happen to be in these counties, DeWitt, Piatt, Douglas, any of these white counties, it's not available. So in those counties, the yields did not fall, or yield in that county or the adjacent county wasn't low enough to trigger a yield endorsement. Here is what this tool looks like, and I just did, this is a Saline County example. These are the actual yields, county yields for that county, and they're county yields, so farm yield would be much more variable. So if I take the last 10 years of county yields, 2006 through 2015, and calculate the rate yield from that, I'll have a 145, which is the average of those. I happen to have here, this county had a 50 bushel average. YA is available that year, so they could substitute a 75%, 75 bushels in there rather than the 50 bushel actual yield, and I'll show what that does. And also, yield exclusion is available in that year. This farm could choose to either do YA for this yield or YE. With neither one of those adjustments, rate yield would be 145, its adjusted yield would be 145. Its approved yield, and this would be the trend-adjusted yield, would be 154. So if this farm chose yield adjustment, it would go from 145 to 154. Chose not to use it, it would be 145. It chooses this yield, 2012, and does YE. Here's what happens. YA, we put a 75 adjusted yield in there, and you can see here the adjusted yield and the rate yield go up by 3 bushels. The other thing that this farm could do is choose YE. Here's what YE does. It excludes that yield from the yield calculations, and that goes up to 165. There are complicated rules associated with YA and YE, and you get those when you have multiple units. And if you have multiple units in a county, you have to make these decisions for they apply to all the units. There's also cases where there's cups and floors, and if you make YA and YE adjustments, those cups and floors are no longer applicable. So if you're thinking about this, you really do need your expert crop insurance agent to help you think that through. Overall, though, if you have enterprise units and it raises your yields, you probably want to do it. And if it raises the yields on those multiple cases or overall, when you have multiple units, you will likely want to do it as well. This is the same premium calculator. This is the FAST tool version, our Excel version. It exists, and you can get those premiums on the web or in the FAST tool. So now we're going to switch gears a little bit and talk about Ark County and PLC.
Yeah, and so I guess I'll take this section over. And a few very big disclaimers, I think, at the beginning. We've already actually got some questions related to, I guess, what you would call the ARC yield controversy that's going on in North Dakota. A lot of you have probably seen that. So I'm gonna try to qualify everything I show you today. This is my big disclaimer slide. So again, we're talking about 2015 crop year ARC payments. They're still very much projections. We don't know the price that will be used to calculate those final payments yet. To get the estimates we're going to look at today, we're going to be basing that off of the most recent WASDE from USDA. That was the February report. So we're going to take the midpoint of the range that they're projecting and focus on corn and beans today. But again, we will not know the final prices for those two crops until the end of their marketing years, which will end in August. On the yield side, again, we don't know what those final yields will be that FSA will use for counties with ARC programs. So what we're going to do is take a look at the NASS county yields that were released last week, again, to just try to get an estimate of what we think the neighborhood of those payment levels will be in different areas of the country. As you'll see, NASS county yields doesn't cover all of the counties that FSA will cover for ARC programs. There's actually quite a few counties that I wouldn't call them major production areas. That's why they don't have a NASS yield. But there are quite a few counties that are not covered by those NASS county yields, which means that the NASS yields won't be used in the final yield calculation that FSA does. They are used as as one of the pieces of information that determines FSA yields if the NASS yield's available. But again, as you'll see, some counties don't even have a NASS yield. So other yield information will be used, and those final FSA yields, Gary, August timeframe on those also. That's what we had last year.
September was when we had those the final yields. By the way, the controversies occur when NASS does not release yields. So if you see your yield up here, you probably won't be in a county with a controversy. What happened in North Dakota is they had NASS yields for a number of years, and then NASS did not release a yield, so our FSA had to estimate their own yield.
All right. So, and that being said, also again, we're using the NASS yield directly reported from NASS as of last week. Even those yields will have, in some cases, some not so minor adjustments even, but in I think the major producing areas, the adjustments are relatively small. So I think we have a pretty good idea of what on the yield side, at least where we have that NASS yield information. All right, so first we'll take a look at the price side. That's really the big driver of ARC payments or expected ARC payments for the 2015 year. Also, most likely, pretty likely, there will be some potential price loss coverage payments. Although, if you got corn or soybean base, the sign up statistics indicate that the vast majority of you are enrolled in that ARC County program. For wheat producers, I included that one up here on this slide since that was more split between ARC County and PLC enrollment. But you can see there the February WASDE range for the three crops, the midpoints, $3.60 for corn, $8.80 for beans, $5 for wheat. Again, $3.60 and $8.80. Still potential for movement in those. You can see the range they're projecting is still relatively wide. Wheat, we're approaching the end of we're closer to the end of the marketing year on wheat, so we're more certain that $5 price will be somewhere in that neighborhood. Also put the PLC reference prices up there, and then you can see if we hit those midpoints exactly, which again we won't, but if we're in that neighborhood, we'd be looking at a PLC payment rate of about 10 cents on corn. Most likely no PLC payments on soybeans. If we moved very close to the low end of the WASDE range, we might hit a PLC payment. I would say that's pretty unlikely given where we're at though. And then most likely around a 50 cent per bushel payment rate on wheat. Now, how that translates to PLC payments per acre will depend on what your payment yields are. Obviously, the higher your payment yield, the bigger your PLC payment could be if you have any base enrolled in that program. We're going to switch to just kind of focusing on the ARC program, though. Again, staying on the price side of things. Again, ARC is this county revenue program, or I'm talking about the county version of the ARC program, which is a county revenue program. Just to review here, the ARC guarantee is determined by a benchmark price and a benchmark yield. The benchmark price is the same for everybody across the country. The benchmark yield is determined at the county level. So if we take a look at prices here, I'm going to start with 2014 just to illustrate how things changed or actually did not change much for 2015. So 2014, last year's benchmark price was $5.29 for corn, $12.27 for beans, $6.60 for wheat. That was based on 2009 through 2013. And you can see the prices that were actually used in that average, in the Olympic average there, highlighted in red. So for all three crops, it was actually the 10, 11, and 13 marketing year prices that went into those averages to determine the benchmarks. Transitioning to 2015, we have the 2009 price roll off, the 2014 price come on. But in the case of corn and beans, we dropped the low price from 2009, and we added what ends up being the low price for 2014 when we do that Olympic average. So it's the same three prices that determine the 2015 benchmark. So even though we saw prices come down in 14, that benchmark did not change for corn and beans, and actually increased a bit for wheat. We rolled off a low price for wheat from 09, rolled on the $5.99 in 2014. That ended up actually bumping up the wheat benchmark by 10 cents per bushel. So ultimately here, what the effect this had was didn't change revenue guarantees much for corn and beans across counties, at least on the price side. Wheat, you may have seen a slight increase in your benchmark revenue because of that increase in the benchmark price. Again, NASS did release their county yields last week. Maybe more than focusing on the numbers here in this map, I just again wanted to emphasize the fact that we have some counties that had an ARC program in 2014, and we would expect them to also have an ARC program in 2015 for corn, but they do not have a NASS yield reported, and that's all the counties that you see there highlighted in gray. So again, not in the major production areas, but a number of counties where other yield information will be used to determine those FSA yields for ARC.
We had a comment here, which is true. A couple counties here have yields that are 20 to 30 bushels below the NASS yields. Typically, those are based. What NASS does is consider FSA failed acres in there. They typically happen in counties with a lot of dairy and silage in them. That's also true. So if you're looking at your county, the FSA will likely be below this NASS yield, and it could be below, which actually would mean that the payment would be higher than we're currently projecting.
Yeah, so I guess you could view our payments as being on the low end, although in these low yield cases, a lot of times you're already hitting the max. Yep. Which again is the biggest payment you can get on county ARC is whatever 10% of whatever your county benchmark revenue is. So you'll see here I've got some counts here on how many counties hit that 10%, and it's quite a few in some of the major corn and bean producing states. So again, here's the county yield coverage. Again, just wanted to illustrate the fact that we're not covering all ARC counties here. This is only where we have a NASS yield to put together a payment estimate. Another thing that I did here just to try to illustrate here, I've got, again, the county shaded in gray, which we're assuming we'll have an ARC program again in 15, but no NASS yields available. And then I've got three different colors here, three different series on this map. And this is looking at the ratio of the 2015 NASS corn yield to what the ARC benchmark yield is for 2015 in that county. And the reason I chose the values I did in this map is given the low prices we have, we can see yields above the benchmark and still triggering payments. And in fact, for corn, your county had to have a yield that was at least 26% above the benchmark yield before the ARC payment would go away or go to zero. If your yield was somewhere between 12 to 26% above your county's benchmark, if your county yield was in that range relative to that county's benchmark, you're going to get some level of ARC payment. And if you're below that, still potentially above the benchmark, but less than 12% above it, so the lightest shade of red here, that's the counties where the maximum ARC payment is going to be triggered. It's going to be that full 10% of the benchmark revenue. So again, if we take a look at how many counties are actually going to receive payments across some states here, I highlighted Illinois, Indiana, and Ohio, kind of the heart of the Corn Belt, the three states that in addition to having the low price effect, had good yields, but not maybe as good as other parts of the country relative to historical. About over 90% of the Illinois counties expecting an ARC payment. Same for Indiana. Almost every county in Ohio expecting an ARC payment. And then you can see also in the last column there, a good portion of those, the majority, over 2/3 in Illinois and Indiana, and again, almost all counties in Ohio looking at that maximum ARC payment of 10% of whatever your county revenue guarantee is. So a lot of counties with payments, a lot of counties with big payments, I guess is the message here for corn. I did include another map here with estimated payment levels. Again, this is only showing you the counties where we have a NASS yield. So if you're in a county that's white here, it doesn't necessarily mean you won't have an ARC payment or an ARC program this year. It's just that we don't have a yield yet to get an estimate for that. And you can see a lot of dark red on the map here with payment rates, in the $50 or more or $60 or more per acre. In terms of payments that'll be received on corn base.
Again, that's assuming that we have a 360 yield, or 360 price. If those prices go up, which would be a good thing, those payments would go down.
All right, transitioning to soybeans. Again, we'll take a look at kind of the same information for beans. Again, here's where the yield data covers that was released by NASS last week. Again, gray counties here. If you happen to be involved with a county that's in gray on this map, had an ARC program in 2014. We just don't have a 2015 NASS yield to make an estimate. FSA will have to use some other yield information to get that final FSA yield. Again, I think, Gary, if you want to just go back and summarize some of the things you talked about.
By the way, just we had a question. What are these ARC? Those are the yields, and these are the ARC payments. We're stating these ARC payments on the ARC program. So if you had to enroll in ARC, these are on a per base acre basis.
That should be clear on that, because again, it can get confusing. There's a lot of steps that they do in the calculation. So I labeled these as corn payment rates. That's if you go to FSA's website and you want to look at, for example, what the payment was in your county for the 2014 year, or if you want to look at what payments were in other counties, FSA does have a spreadsheet for the ARC county program that shows all crops, all counties, all practices, what the yield histories are for each county, what their FSA yields were for 2014. What the prices were, the benchmarks, revenue guarantees, all that information. And what they report in there is a payment rate. And that is before the 85% is incorporated. You can look at that as reducing your payment per acre by 15%, or you can look at it as you only get this payment on 85% of your base. So this is before the 85% is factored in. So if you want to multiply all those numbers by 85%, that would be the payment per base acre that you'd be looking at.
The other question is your 360 price really too low for the projected average? That's a WASDE estimate, so it came from the government, so it must be right. Actually, if you're looking at it, though, it seems pretty reasonable at this point in time for the prices that we've seen. Unfortunately, we are in that range, and that does seem somewhat of a realistic range to be in. One other question that we had, and by the way, we had what does a 5% value at risk? it's a 1 in 20. A good way of looking at it is 1 in 20 years revenue on that operation will be below that. That's a good way of looking at it. Is YE based on for all units in the county, or can you select specific units to exclude or not? YE, again, going through YE is a yield exclusion. You have to have the county state or county yield or county crop year be available. If you select it, it applies to all units for the crop that you selected.
Got a few questions here. A question about didn't show a map for payment levels for soybeans for Ark County. I do have that information. We are actually going to release a daily article today that will include some of that. We'll include a national map as well as a little bit more detail on payments in Illinois counties. So if you want to take a look for that, probably by close of business today, that'll be up on Farm Doc Daily. We'll probably follow up with some more analysis. Again, the yields were just released last week, so
those yields we're in the process of putting those in our Ark County Excel sheet as well. If you download already, you can get the 2014 final, and we're putting the NASH yields in for those counties where we have them. So that will be up in the web this week yet as well.
Also a question on sequestration. I know sequestration did affect 2014 payments, Gary. They reduced those across the board by a fixed amount.
What's that?
Sequestration, that did affect 2014 payments.
Yes, sequestration
6.8%.
6.8%.
In terms of how that'll work for 2015, I don't think we know that yet. But again, the numbers I showed you on that map, Again, you didn't see any details on a county level basis, but just the ranges that I showed up there on that map for corn. They would not have included any sequestration reductions in them.
We had a comment: YE's on an APH unit by a unit basis, not by a crop or county. So I stand corrected. So, just to summarize here, we're looking at a low profit loss year. We would suggest taking high coverage levels, RP, ARP, probably looking at enterprise units and taking TA, YE, and YA if they're available. We also had a question: how do you mix Ark County and crop insurance? And actually, my personal opinion is that you don't. Doesn't matter. You probably still are going to be at the highest coverage level no matter what on your crop insurance, regardless of whether Ark County is making payments or not. The one thing that those subsidy levels really come into play there on crop insurance, and that is that over time you expect more than you pay in. Obviously, some years that won't happen. And the risk reductions associated with crop insurance are pretty large.
And maybe just final questions to get at here. Again, related a little bit to the ARC program. Did want to point out too, and this will be covered in again the daily post that'll be released later today. Corn payments. Corn-based, very likely to receive ARC payments, especially here in the Corn Belt region. However, there are a few counties in Illinois where we do have NASS yields, and those NASS yields with that 360 price would suggest that those counties will not be receiving an ARC payment. Their yields were high enough relative to their yield benchmark to take that payment rate down to zero. And those three counties were Monroe, Piatt, and Pope. Again, there's still a handful of counties or a few counties that don't have yield data even in Illinois, but of the ones that do, just those three that had a zero payment. Other question we had, again, before we wrap up here is some sense of projecting payments for ARC for 16, 17, and even 18. I'm not even going to attempt 17 or 18. What I would say about 2016 is that I think payments are probably likely again because of that those high benchmark prices we have relative to where the market's at today. Again, that could change. in the next year and a half, which is kind of the time frame we're looking at for those 2016 payments. But where we're at today, I think payments are likely. They most likely, though, will be smaller than in 2015 because as prices remain low, eventually that benchmark price and those revenue guarantees do come down, lowering payments, lowering maximum payments at the county level, and that will start to happen here next year if we have another low price that rolls into that 5-year average. A couple of final questions here just on the webinar itself. Again, the recording will be available afterwards. It does take a little bit of time to process, but
figure day at least.
Yeah, definitely. I think by tomorrow, if you went to the Farm Doc site, most likely even later today, there will be a link to a YouTube video with the audio and what you saw on the screen that you can watch anytime. PowerPoints also available on the Farm Doc site. You can also download them, I think, still from your screen. There should be a handout tab that you see on your control panel there. 4 different options for handouts. They're all the same material. They just have different numbers of slides per page. So depending on how much paper you want to print off, you can choose one of those. So it is 6 after 9, so we've already run long. But thank you for joining us this morning.
Yep. Thank you. Have a good spring.